Hello, I'm Richard Mize, real estate editor for the Oklahoman and News OK, talking today with Jim Parrack and Susan Brinkley of Price Edwards and Company. It's the largest local commercial property brokerage in Oklahoma City, correct?
That's correct.
Jim is Senior Vice President and Susan is retail property broker, and what we're talking about is the mid-year retail market summary just issued, fresh off the press and fresh onto the internet.
That's right.
By Price Edwards. And so, Jim, the first thing I wanted to ask you was, you say early in the report that retail is becoming a story of haves and have-nots in Oklahoma City. What do you mean by that?
Well, I think it's been well demonstrated over the last couple of years that our retail market's been strong. And as we've reported the last couple of surveys, newer properties built since 2000 are full. Vacancy in them is about 3%. And so that has kind of created demand for new development, which we talk about in the survey as well. But what we don't talk about a lot is the older properties. As we've gotten through this cycle, there's been our product is aging. A lot of it is, and there's this group of properties that are older. Perhaps have some deferred maintenance. Some of them may be owned by owners that either are unwilling or unable to improve them over time. And so we've kind of developed a stock of properties that have some higher vacancy. And so you end up kind of having a little bit of a barbell effect where you have the new stuff that's doing well and is full, and you have this older product that ultimately is going to need to be repositioned or torn down or something done to it, but has a pretty good vacancy in it right now.
Is that in what size range? Is that across all sizes, or is it kind of clustered in one?
There's a little bit in all sizes, but it's more in the larger properties. And so, one of our sub-markets is a good example, the eastern Oklahoma County, where Midwest City, Del City is. There are 7 properties in that market that are over 25,000 square feet that have at least 25% vacancy in them, some of them 35. And it's usually that older product that sometimes it's in an area that retail's moved away from, but oftentimes it's just product that hasn't been updated, has deferred maintenance, just retailers don't view them as positively anymore.
But if you've got 65% occupancy in a property, somebody's using it, and you've pointed out to me before that there's a need for low rent.
Correct.
In all aspects of property, and so it's not that they're, quote, slums, it's just that they're low rent.
Right.
Serving a certain part of the market.
There are, a lot of people don't realize it, but the vast majority of retailers are really mom and pop retailers. And a vast majority of retailers are really small one-shop retailers. I think there's a statistic in the survey that talks about 71% of retailers have 10 or fewer employees. And so a lot of those smaller retailers can't really afford to pay the rent at some of the newer centers. If you start getting over $20 a square foot in rent, there's a lot of those mom and pops that just can't go there. And so they do need to be somewhere, and they typically like to be in more neighborhood oriented locations. And so sometimes those older centers with a cost advantage can rent to them for less, and it ends up being a win-win for both of them.
And they would have more neighborhood oriented customers.
Correct.
I would imagine.
Correct.
And they're not destination properties in the sense that we might drive to Memorial Road for Top Golf, but they are neighborhood destination properties, and that's where I go to have my nails done, not me, or to get my hair cut, right?
That's exactly right.
Right. All right, let's talk about big dollars and big deals. The big deal of the year so far was the Belle Isle transaction, wasn't it? Talk about that and what it signifies.
Belle Isle Station sold in May. It was sold to Kite Realty, who owns 3 other properties in town. They paid $51 million for it. The reason it's a big deal is it sold at a very low cap rate. By our numbers, it was a 5.4% capitalization rate, which is a full 125 basis points lower that cap rate than any other of the big box center sales in the last several years.
Now let me woe you
I knew
right
you
there.
I knew you were going to stop me there.
Unpack that jargon. We all have jargon, and cap rate, capitalization rate, is one.
Right.
What does that mean?
Capitalization rate is used by investors in the industry that really is a number of things technically go into it, but it's the return that you expect to get on the property. And so there's factored into it a safe return, a risk return, a return to your equity. And so investors use it to value a property. So you take that capitalization rate, you divide it into the net operating income of the property to come up with the value. So that is really what it means.
It's a measurement of value.
Correct.
Because in income property, the value is the income stream.
That's correct.
Not the nuts and bolts and the bricks
Right.
and mortar necessarily, although that has something to do with it.
And so a capitalization rate that low says a couple of things about the property, and I think we can infer a couple more things about the Belle Isle Station sale. One is it's in a great location. It's next to Penn Square Mall, which is where a lot of retailers want to be, the best mall in the state and one of the better ones in the region. And so it's in a good location. Nordstrom Rack is there, which is a great tenant. Their being in the center helps drive down that cap rate. Great credit. They draw tenants or shoppers to the center. I think it also, though, speaks to the high price, speaks to the amount of money that these national REITs and national investors have to place. And so there's a competition. And so when you have a competition bidding on property, it drives up the price, drives down the cap rate.
Wasn't that property built in 2000?
It's
2000, 2001, something
it's
like that?
15 years old.
Okay. It was one of those that, to me, it was like when it started coming up, I thought, and maybe some others did too, well, of course.
Right.
Why didn't somebody put that there before now? Because it is a great location, right smack in the middle of town, very visible. Now we can't avoid. Do you have anything?
No, I was just going to say
it
speaks well too to Oklahoma City, and we've talked about that before about how the national image among investors of Oklahoma City is much better, and to have a cap rate that low on a property that nice speaks well to what people think of us.
They're willing to make that investment despite that relatively lower rate of return.
That's correct.
Okay. Let me turn to you, and I'm going to come back to you for a final question, but let's talk about leasing. And as I said before we started here, I don't write much about leasing as leasing. We talk about deals, particular deals once in a while, but leasing as leasing we hardly ever talk about. So characterize it by velocity or by trend, or in some cases and in some markets that sometimes there are concessions given. I mean, just talk about the leasing process right now as you're experiencing it, and then look forward a little bit.
Well, I think we're starting to see lease rates increase all across the board, even the properties that we were talking about a little bit earlier that may have some vacancy. A low-end rent used to be in the $5 to $6 range. Now I don't see much below $8. And we're starting to see on the high end rates that have gone into the 30s, some even higher than that for very specialized product. That's a really good indicator of what is going on in Oklahoma City and what we are able to ask for and actually get. In order to get the rates, there has to be tenant improvement dollars spent by a landlord. It all becomes part of the math equation at the end of the day. But on the new developments and in the Penn and Memorial area, up in Edmond, they're doing some beautiful projects, and what Glimcher has in mind, of course, for Class and Curve, Triangle, Nichols Hills Plaza. I think you're going to see anywhere from $25 to $35 in rents, and the nationals are able to pay it. This kind of will separate the tenants from what the nationals can pay, and then you've got your locals that we were talking about a little bit earlier also. And they do need to have something more affordable, and we've got plenty of that product also. There's a lot on the horizon. There are tenants that have never been in our market before that are making announcements or looking around, and to me that's just incredibly exciting.
Name some names. That's what people want to hear. People are
we
insatiable in their desire to know who's snooping around Oklahoma City. They want to open stores, so name some names.
You know, cannot be confirmed,
of
course.
That you can name.
But you know, we've all heard Trader Joe's and REI over at 63rd and Western, which I'm very happy to hear because I live over there. But you know, we've heard that Whole Foods has done very well. They may be looking around for one of their smaller concepts called 365. Well, we know Main Event just opened. Winco, we've talked about that. Another grocery store entering the market. H&M is going to be opening soon, the first store in our market, and they'll be at Quail Springs Mall.
All right, let's wrap it up with this question.
Okay.
The gorilla in the living room still is the oil business and oil prices. What's the latest thinking in your crystal
always
ball?
comes up in discussions, but it's very interesting to me for someone who lived through the 80s bust, and that is that at this point anyway, from the activity we're seeing, from the retailers that Susan and our brokers are talking to, it really hasn't had much of any effect on retail yet. You know, retailers live and breathe by income growth, population growth, job growth. Those numbers really are still good, and so those economic indicators haven't deteriorated. I mean, we've seen a little tick up in the unemployment rate recently, but it's still really low. And so we have not seen the retailers react yet. Keep in mind, retail is kind of a lagging indicator. So until those numbers start to suffer a little bit, retailers probably aren't going to care that much. Which gets back to the question to me really is, how long do oil prices stay down? If they stay down and like they're doing now, trend lower for another 18 months, then I think we'll have a problem and start to see some cutback. But if they start solidifying and trending upward, and so 18 months from now, oil's at 70 or 75 instead of where it is now, a barrel, then we may not see much effect at all in the retail world.
It's that and the eternal question again, how diversified are we really? I mean, you can say it and you can say it,
right.
But the proof is in 12 to 18 months from now.
That's correct. I mean, it's one of those things where I would like to believe that we're more diversified. I'm not convinced that at the end of the day we are, right. And the proof will be, as you said, right. 18 months from now.
Very good. Thank you so much, Jim and Susan. I'm with Jim Parrack and Susan Brinkley with Price Edwards & Company in Oklahoma City. I'm Richard Mize, real estate editor for the Oklahoman and News OK.